Today is Meta slash Tesla rides the uh, booster rockets from S&P 500 um, that is largely facilitated by John Bogle's Vanguard. This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. We also want to thank our Patreon supporters. If you enjoy the show, would like better ideas on investing and trading, please join us on Patreon. So on the weekends when there isn't any market news to mess around with, there's an opportunity there to sort of get a feel for where investments look and where there might be, some unexpected places to find value or growth in the stock. Today is a little bit unusual because we're kind of rotating how Meta as well as Tesla are operating, and then we'll sort of close it out with where I think Tesla goes based on all these rules. So I want to go backwards in time and note and situation and note that there's an entity called CalPERS, which stands for California Public Employees Retirement. So in the good old days of 15, 20 years ago, they were about a $250 billion fund. Now they're above $1 trillion, probably 1.5 trillion. Why are they a big deal? Because it turns out that there's retirements in every state of the United States. There's retirements for companies. And when you go through those retirement plans, you can then take a look at how money moves within mutual funds, which tend to be similar because a lot of them are focused on the S&P. Now, I should warn you that this show, we're sort of doing some reverse engineering on, in general, how the market is working and why. And so the goal here is to really give you an opportunity to dig into the type of data that will influence your investing. And so to that end, what we're going to be looking at first, obviously, we're taking a look now at what the S&P is composed of and who buys it. So we're going to finish that portion up, and then we're going to look at some other aspects or angles of the market. So we can, instead of just say, let's look at a tree, we can also say, let's look at the forest. So the next thing I want to note is that a very strange thing happened when we started going heavily towards John Bogle's Vanguard, the whole S&P 500 thing. Why did people do that versus just saying, can I pick the right mutual fund and therefore do well versus going for the index? Well, the issue that popped up was a lot of investors started asking the question, how much more do I earn paying extra fees to a money manager or mutual fund or anybody else rather than just doing an index? Indexes are good things, and there's a reason why they've collected greater than 50% of the assets, probably now heading to 60%. And the reason is that what index investing has yielded is, in theory, 1 or 2 basis points more return, but the cost related to that extra return just isn't worth it to a lot of investors. So where does that leave us? Well, what's interesting now is, instead of learning the behavior of specific stocks per se, you end up in a circumstance where you're kind of saying, okay, yes, we want to know what that stock is going to do, and there are going to be up and downs on it, perhaps large up and downs. But then you have to start asking the question, well, who is the S&Ps and who's in the S&P? Obviously, Tesla is in there, but Tesla is also in a whole bunch of hybrids. It's like in big cap growth, NASDAQ 100. There are all these other indices people can use to try to find growth in their stock portfolios, but not just necessarily be a slave to what the S&P is doing. Another one that is big now is, if you think about it, Meta and all these other companies are part of, the fastest growing portion of the S&P. So that's the technology portion of the S&P. So that's another way that people have chosen to slice this in order to try to get the win. Well, another thing kind of happened that was kind of weird that's transitioned over the last, let's say, 100 years. So if you think about it, I've been reading the financial pages for the last 40 years. And there's a rule of the financial pages that was in place that sort of disappeared over the last 10 or 15 years that has changed the landscape. And that is market PE. What do I mean by that? Well, if you were 10 or 15 years ago and somebody asked you, wait a second, are you a value investor? If you are a value investor, that means if you're truly a value investor, you're trying to get a stock when you buy it to be at a low PE, at a PE that's below competitors, that's below the growth rate. And so one of the other huge PEs that a lot of people used to watch is something called the market PE. So what does that mean? Over the last 100 years, 14 was sort of the average PE of the S&P and a number of other indices. And so in theory, if you wanted to be a value investor, all you had to do was make sure that you tried to buy an index, let's say, at as close to a low PE for the market as you could. And when does a low PE happen for the market? When the market's been down for a while or very negative, that's when certain types of investors, Warren Buffett, for example, comes to mind, are all in. When the stocks are at the upper end of their PEs, guess what? Warren Buffett and those guys aren't buying a lot of things. They're stacking cash so they can buy at the bottom of the cycle and get the cycle to pay them off. So as a test of this, I kind of glanced. So I want to ask you to type into Google, what is the S&P 500 PE ratio currently? And what you're going to find out is 27. And you're going to say to yourself, oh, it's 27. That might mean the market's about to crash because we're at a high PE ratio relative to historical what those PEs are going to be. And you would be right. And it would totally make sense against the value investor, everything that's taught by, any investment guru you could think of. Well, there's something weird that happened over the last, let's say, 5 years as Tesla has emerged as a giant firm. That weird thing that's happened is something called the growth of the percentage of the marketplace that's controlled by giant private equity funds. So let's say 5, 7 years ago, they were 5% of the market. Now they're 20% of the market. And that increase is rising over time because the large firms are figuring out how to combine to take companies private, leaving fewer companies for large funds or large entities to invest in as they prepare for people's retirements, as well as for other individuals. So this is a really interesting situation. And I think it's fascinating because the PE ratio that should have been there, that was there, let's say 5, 10 years ago, totally gone. The reason it's gone is there are a lot fewer companies. So let's say there were 100, you drop by 20%. That means there's more population over time. There's a greater amount of cash above 100 hunting for a smaller number of companies. And because how good private equity firms are at delivering on their mandates, you're going to keep seeing fewer and fewer stocks that people that want to buy into the marketplace can put their retirements. So the picture I'm drawing here, in case you've gotten lost a little bit, is just the fact that we have these giant pension funds, the one that the company you worked for, or the state that you live in, all those employees at the police department, all those different entities, they have cash coming in every month that has to be invested. And they're finding themselves in a position where they have fewer and fewer companies into which they can put their monies. So what do they end up doing? They have to buy what's available that fits certain parameters. And so what all this means then is that you can have a higher PE for the whole market now than you did 5 or 10 years ago. And that PE is going to keep increasing. And those investors have no choice, particularly if at least half, if not three-quarters of them, have their money in some kind of index. It could be a mutual fund, but more than likely it's going to be S&P or one of the indices that I just described. So why does all this matter? Think about Tesla this week. Yes, the stock price was down, and guess what? After they came out, people looked at those numbers and said, oh, by the way, it's nice that they're down. It is a problem, but I incrementally need to find a place to put money that allows me to deliver better returns than other people are getting. So I got to take risks when there are not great, but decent companies that are available that can be invested in. People are piling in. So one group is saying, we're running for the hills. There's a problem at Meta. They're going to be spending money. Their price earnings ratio isn't going to be as good because they're not going to deliver as much earnings to us. Same thing with Tesla. Hey, those guys are investing heavily in growth. They're not going to grow as fast. And then we're finding all these, if you will, pension funds, index funds, all these different entities that are buying in when other people are running for the exits. So I'm not saying I have the 100% solution to this, but taking the time to understand like a bigger picture of what's going on can be very profitable because you can anticipate how the market will move things. So for example, private equity has been effective and continues to consume companies, if you will. They do occasionally go public, but then they can end up private again if they're bought out and combined in a certain way. There's a lot of things that could happen there. So the question mark then is like, how do you manage yourself relative to this? Well, the answer is understanding a broader range of what's happening could be very lucrative. So one of the things that's happening now is there's a prediction, oh no, the PE ratio is very high. This could be very bad news. Well, that's absolutely the case, but there's a few problems with that doomsday scenario. The biggest one is, as you know, there's $60 billion, or I guess it's a total of $90 billion between support of Israel as well as support of the Ukraine war. That's a lot of money. And that'll be spread among, I would say at least 50% goes to defense contractors because they have to make not only bullets to support equipment already there, but new equipment as well as, so greater than 50% of the purchasing, I believe, will be in the United States companies, like a Lockheed, all those names will make a lot of money off of this war. That war is probably not going to end for a year. We're thinking 2 or 3 years out. So what's happening right now is that, yeah, oil is suffering a little bit because prices are higher, which reduce consumption, but the defense contractors are cleaning up. They're creating inflation with the money that's being used to buy that equipment. But in general, there's a lot of people employed in the process of producing all that gear. And so all those people are buying houses, cars, everything they need, and they're not unemployed. We also have the AI boom that's happening right now, another heavy spend that's re-employing people that have been laid off, by the big tech firms, currently. So the issue that's coming up right now is, I agree recessions happen. I agree one could happen now. The problem you have is if you're funding World War III with all the allies throughout Europe that have really nice amounts of loan ability to get equipment, and the United States arming Ukraine, you have a lot of spending there. And the more you spend, the more people have jobs. And it's hard for recessions to happen when all the people that work at those companies have enough money to buy what they need. So what I want to argue, therefore, is, hey, if the war ends, Obviously, oil prices are going to fall. That'll screw up companies with lower oil prices too. But in general, I just think that there's a bunch of sectors of the economy that are doing pretty good, even if there are a few that aren't. And those pretty good doing sectors employ people, and those people buy stuff. And so, from my standpoint, I believe we're in the zone right now where, yes, PE ratios are high, yes, prices are high, but the environment, the way it's baked right now, suggests that, hey, there are companies that you thought their stock price should get slammed, Tesla, for example, because of declining sales, let's say, and profits. But the other problem is when a large institution is told, get into those indices and you have no choice about it. And every month we have a certain amount of cash coming in. At least half that cash is going to those indices, therefore to the companies within the indices. You have this weird thing happening where all the normal processes of selecting companies and investing that you might have seen 10, 20, 30 years ago are getting thrown on their heads. Now, obviously, there are companies that have to get big enough to be in an indices, so that's another issue. But in general, we're just in an interesting time now where how investing is done and why is sort of shifting in certain directions. And I really think it's worth your time to sort of dig into what I just described, because I think it gives you insights in the larger picture of sort of where the market is and where it's going, where you can make some great money. At any rate, I want to thank you for joining us. All of this said, I think Tesla benefits from this phenomenon and keeps rising, and nobody can explain why, given that earnings and revenue are down. And this is, I think, part of what you might want to think about. At any rate, this is Greg for Teslafaninsight. My health tip reminder for you today is one of our psychiatrist folks. I'm trying his recommendation. He recommends 20 minutes of walking every day, early in the day, and then you could have your regular workout when you're going to do it. But I'm trying that as well, and I think it's pretty awesome. Generates some endorphins, a little bit healthier for you. Might be something to consider. I have not been doing the other recommendation, which was at least twice or three times a week, trying to get the weight thing going. I have some hand weights, etc. I could bring along with my walk. That might help in the process. But I wanted to mention this to you as well as something to consider. At any rate, this is Greg for Teslafaninsight. Thanks once again for joining us. We look forward to your comments on this. And tschüss, au revoir, le hitro, hoda havezra, jiche ni hao mat, kombawa. And in Jamaica, we say enough respect, walk good, namaste. Thanks for your time. Have a great day, and bye for now.